Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is Fergus Hodgson with the Gold Newsletter Podcast. Thank you to everybody for tuning in. I'm really pleased to have Ben Hunt on today. He is going to be discussing game theory as it can be used in finance, particularly with regards to gold. He is a co-founder of Second Foundation Partners, which publishes Epsilon Theory. He has a PhD in politics and government from Harvard, which we will not hold against him. And he has been a startup tech entrepreneur and a senior manager of a hedge fund. So he has a great pedigree. There's a considerable email or subscriber audience, about 100,000 people who subscribe to his publication. So a wonderful guest. Ben, I'm so pleased for you to join us. Thank you.
Great to be here, Fergus. I appreciate it. Thanks so much.
There's so much to get to here. Why don't we just step back a second and describe the evolution of how this Epsilon Theory publication or platform came to be, because you describe it as your pack. And, so it's not only a publication, but it's almost like a crowdsourced intelligence, gathering operation. So what is this Epsilon Theory platform?
Well, that's a pretty good way to describe it. I like that. So, I've been managing money for a lot of years, both with the hedge fund I managed and then with a, large asset manager where I was the chief investment strategist. And, throughout it was really noticeable, not just noticeable, is, it's so palpable to me, and I'm sure to a lot of your listeners, about how the investment environment really changed after the Great Recession, really starting in March of 2009 with these extraordinary intervention policies from central banks, right?
Yes.
Starting with the U.S. Fed, moving over to the ECB, the Bank of Japan, and now, everyone's in on the act. And what I mean by the act is not just the actual buying of stuff, not just the actual expansion of balance sheets to purchase, bonds, and in the case of, the Bank of Japan and Swiss National Bank, like actual equities around the world to actually prop up financial assets with actual purchases. What I also mean, and frankly, I think this is the more important driver of the real change in the investment landscape over the last 9 years, and a couple longer, is the role of what I like to call narrative in words. It's the press conferences, it's the speeches of whether it's Draghi in 2011, whatever it takes, and that impact of just words on the European markets, whether it's the ongoing impact of the statements and speeches by the Fed chair, whoever that might be, and the Fed governors. It's all part of a very conscious and strategic initiative by central banks to use their words to influence investor behavior. And so what I'm trying to do is, well, how does that work, right? Is there a structure, is there a set of rules that we can examine those words through to see how they impact investor behavior? That's where the game theory comes in.
Just enlighten some of us, because I've heard that term game theory used in just basic, economic theory or economics in the academic setting. What do you mean by game theory?
Right, it's used and misused, right? I mean, it's thrown. I think the only phrase that's thrown around more than game theory is probably artificial intelligence, right?
Sure.
I mean, it's one of these buzz phrases that gets tossed around and misused as often, or probably more often than it's used.
Most of us don't know what it means, so it's easy to not necessarily intimidate people, but to speak over them.
Exactly, and it is used to intimidate people. But look, game theory is a really simple thing, and I'll use a poker analogy, all right, which is something that kind of, I think for most people kind of brings it back home into something that we all have experience with. So, there's that old expression in poker that you don't just play the cards, but you also play the player, right? And playing the cards I would think of as like investing or thinking in terms of fundamentals. And, for your gold enthusiast, let's say, audience, right? I mean, would be looking at supply and demand, and, you see these arguments and these issues come up, and they're important. They're always important. The fundamentals are always important. But we also know that whether it's poker or whether it's thinking about what drives the price of gold or any security, it's not just the fundamentals, right? It's also the other players sitting around the table from you.
Right, how they interact with you, right? Basically, how the players engage.
Yes, exactly, right? And it's that strategic interaction where each of you in poker, you've got some information that right? It's the cards you've got, and it's how you represent those cards to other players through your bets and your bluffs and all like that, and then how the other players react to you, and how you react to the other players reacting to you. That's game theory, right? And it's not just random, as any good card player will tell you, right? There are rules, right? Principles for where the betting or the play ends up, and that's what you would call an equilibrium in game theory. The technical definition of game theory is a strategic interaction of choices between two or more players. And what that really means is, in poker terms, you play the player. That's what game theory is all about.
Mate, this is just delightful, but, fascinating. I really want to pursue more. I mean, we all remember the Nash equilibrium from Economics 101 back in college. Now, I'm going to quote from your article, How Gold Lost Its Luster.
Oh yeah, that was one of my earliest notes. That's right, back from 2013.
Right, and I should have mentioned this earlier that your platform, it got started in 2013.
Yeah, the summer of 2013. It's funny. So I was running it was a big hedge fund, and we had done great in 05, 06, and 07, and we also did great in 08. And then from March of 09 onwards, it was like you went to the wall and you just kind of flipped a switch, and our returns just flatlined. We're long, short, stock pickers and the like. And so, we never lost money for clients, but what we were doing, right, looking at, playing the cards, playing the fundamentals, it just wasn't working anymore. And so we gave all the money back in the hedge fund, and, I started trying to figure this out, right? What does work? What is driving markets today? Because it sure as hell ain't the fundamentals, right? It's something else, and that something else, I really believe, is what we would call in game theory the common knowledge game. And this is something that's been in markets forever, right? So, you go back and you look at all the old, titans of Wall Street, right? The Cornelius Vanderbilts and the J.P. Morgans and the like. They're all talking about. Well, I tell you what, they're not talking. They're not talking about free cash flow models and fundamentals. They're talking about the stories that people tell about stocks and the way that those stories take hold of investor behavior. And I really think we're reliving that today. The difference is we've got, I think, a set of rules that we can try to understand what drives that game playing today. And again, in game theory, we call that the common knowledge game. And what drives the common knowledge game is what we call missionaries. So that's the Fed chair, getting up and giving a press conference. That's, Warren Buffett appearing on CNBC, right? Or Trump sending out his tweets. Those are all missionaries, and there's a measurable process for how you can tell, how those messages percolate through investor behavior.
Right. So basically, you're just saying that you look for, I guess, information agents, or you call them missionaries, who then drive the prevailing narrative. And
yeah, that's right.
So in the one quote I wanted to pick out here was that if we're going to apply game theory to gold, this is all bold in the article, gold is just not important in the same way that it was 100 years ago.
Right.
And that shift in meaning makes all the difference in understanding the price of gold. Okay, how do you actually take our observations about these missionaries and quantify them.
So here's what that quote means. What that means is that 100 years ago, right, when you're talking about, the original J.P. Morgan, right, Jupiter Morgan, right?
Yes.
And he had that famous quote, right, gold is money, everything else is credit. And that really is what gold meant 100 years ago. Gold was money. It was a store of value. That's how people, and when I say people, I'm talking about crowds of investors, how they thought about gold. That is not the way that, I'll say, institutional investors, how the drivers of markets today, that is not the meaning of gold today. I will tell you for a fact, right, no one in the institutional investment world thinks of gold as equaling money, right? What the conception of gold is, it's an insurance policy against central banks screwing things up. That's what it means, and that change in meaning has it makes for a very different world in how you have to think about the price of gold. You may think that gold is money, right? I get that.
I mean, that's largely idealism, because it is true that gold has been used as money in various forms. However, for the last 40-odd years, we've been off a gold standard, right? And there's no connection. So that, as you said, that has changed, gold's uses or understandings. And there's not really any dispute that a lack of confidence in central banks does drive more people to both invest in mining stocks or just actually in holding it as a protection.
And what I'm saying for you is that you can actually measure that confidence in central banks, right? That the central banks have got your back, that the central banks will prop up the market or what have you. That you can actually measure the strength or the delta, the change in the strength of that narrative. Right? That's what I'm talking about.
That's my question, though. How do we actually get a metric to get a handle on that?
Yeah, well, it's a technology, again, that I call it a technology. It's called natural language processing.
Okay.
And it's not cold fusion. It's not some crazy invention. These were academic white papers that were written 20 or 25 years ago. And, I was looking at this stuff back, 30 years ago when I was getting my dissertation done. But what natural language processing is all about is trying to use computing power to read the statements of and the transcripts of all of these missionaries all over the world who are saying things intentionally trying to influence investor behavior, right? So back 20 years ago was, wow, wouldn't it be great if it were possible to, put under a computer application a transcript of all the things that people say on financial news, all the articles that were written in the Journal and all these other newspapers, all the people who speak on CNBC. Because if we were able to do that, this is 20 years ago, we can actually compare every word in every article to every other word in every other article to read in a way that human beings just can't, right? And actually measure the strength and the cohesion of certain common arguments, words and grammar and arguments that are made in these articles and transcripts. Well, what's happened over the last 3 years is, in fact, we now have the raw computing power to do just that. So it's been I think a fascinating technology development just over the last 3 years, where you've got a number of companies now that basically sell this sort of computing power as a service, right? So Amazon does this, Microsoft does this. And so what you're able to do is you're able to apply massive computing power to some of these interesting problems that were, from a academic point of view, solved. The math was solved 20 or 30 years ago, but now we're able to add the actual computing power to actually make this a real-life application. So that's what we're able to do today that we haven't been able to do in the past. We're able to actually measure the words of all of these statements and transcripts and see really measure the strength and the cohesion of these different arguments about, in this case, central banks.
I mean, central bankers are notoriously difficult to interpret or to understand with their language, right? They'll use convoluted terms or seek to hide almost what they're trying to say.
You know, Fergus, that was certainly the way central bankers acted before
in
the
Great
Recession.
the Greenspan era. Yeah,
the Greenspan era. That was exactly what they would do, right? That really changed in the Bernanke regime, right? So they, and you know, this isn't tinfoil hat conspiracy things. This is you know, this was the subject of a lot of Bernanke's speeches, and it's what they call communication policy. That's the term, right? So this is why you have Fed governors, you know, every week they go out and they give interviews.
He actually took it upon himself to use his platform as a tool rather than avoiding it.
That's exactly right. And this is, you know, it's interesting what people will talk about, you know, when they're leaving office. But, you know, this was the subject of almost all of his speeches towards the end of his tenure, was that they were, you know, when he came into office as Fed chair, he said, I really only had one toolkit, and that was, what do we do with short-term interest rates? We took those down to zero. We didn't really have anything else to do. So, but we need to do more. So we developed a second toolkit, and that was QE, right? That was buying stuff. And Bernanke said, and I would agree with him, look, that worked really well the first time we did it. It worked so-so the second time we did it, and it started to really have negative impacts on what we were trying to achieve the third and fourth times we were doing it. So what do we do then? And he said, well, what we developed, and interestingly, the committee that developed this third toolkit was chaired by Janet Yellen, who goes on, of course, to become Fed chair herself. But it was the development of communication policy. And, you know, it goes by different words. It goes by forward guidance. That's the main word, the main phrase you hear. But it was the conscious use of words to try to change investor behavior. You know, what we might call lying under other circumstances, right? But it's not that they're not telling the truth. It's that the words are being carefully chosen to try to impact our behavior.
They're trying to frame the debate or frame the way we think about things.
Absolutely. They're trying to tell you how to think about the world. This is something that politicians have known forever, right? I mean, it's what good politicians have done forever, but it's really the conscious adoption by this same toolkit by central bankers, and now everyone's in on the act. So, you know, you see this with corporate management, you see this with everyone who appears on CNBC. It's the use of words to the expression of opinion as if it were fact, as if it were news. And one of the most prevalent things, the most prevalent expressions of opinion as if it were fact, is that central bankers have got everything under control, right? And so long as that narrative is strong, gold will be weak, right? And when that narrative weakens, gold gets stronger. And it goes back to that reflection of, well, what does gold mean today? It means it's your insurance policy against central bankers losing control. When does that manifest itself? It manifests itself in terms of the words and the speeches that people are using.
Right. So let me just try and follow your logic here. So first, you've basically, and I agree with you here, that you're explaining that the way we understand and use gold now has changed from a monetary vehicle to an insurance policy against basically central bank failure.
Yep.
In the meantime, right, not only has our understanding of gold changed, central banks themselves have they've changed, right? They've adapted
for sure
and become much more aggressive or interventionist, you might say.
Yep.
So you're trying to basically assess or utilize the information available on central banks to find its impact on the actual price of gold, on its merits as an insurance policy.
Correct. Look, I'll give you a very clear example of this. So, right, in December, when markets were, you know, very squirrely, because particularly after Jay Powell came out originally and said, you know, after the Fed meeting in December, you know what, we're not looking here to bail out the market. We're looking at all these real world, real economy indicators. We think the economy is pretty strong, and so, we're hiking rates, and, we may keep on hiking rates. And so what you saw there was a concern, is expressed in a lot of ways, that the Fed has lost the confidence of the street, right? So they've lost the tune. They're no longer in sync with the markets, right? They're starting to lose control. And what you see, the price of gold did pretty darn well during that period, right? As soon as Jay Powell, though, comes out, it was like 2 Fridays ago, and says, just kidding. We're on hold, and we're looking closely at the stock market, and we're really concerned that maybe the stock market is telling us, we need to pause and really kind of get a grip on stuff. Gold doesn't work anymore. And it all goes back to this notion that what really drives the price of gold today is the confidence or lack thereof that the Fed is large and in charge. And if so long as the prevailing narrative is that, yes, the Fed is large and in charge, gold's not going to work, because you don't need an insurance policy. If there's concern that the Fed is losing control, as I think could happen if you start to get wage inflation that doesn't respond to tightening, well then, right, the narrative shifts and it becomes, the Fed is losing control. That's when gold works. And, I think that's the lens that you have to look through to understand whether gold works or not.
This confidence, however we want to quantify it or assess it, measure it, in my assessment or my view, actually overwhelms interest rates.
Oh yeah, absolutely it does. Again, it's not playing the cards, right? The fundamentals, what is the interest rate? It's not what is the interest rate. It is how are you thinking about that? How are people telling you to think about this interest rate or that interest rate? Right? It's playing the players. That's what's driving the price.
Okay, let's bring in the game theory element as well. So, one analogy. Well, first I should say that in your description on your website, you said you want real change to investing in citizenship. And this is where you bring in your pack and quote something different. And you also, in an interview, you introduced the idea of seeing human behavior like a colony of bees, and the bees themselves, or the sum of their actions, was the animal you focused on. Mm-hmm. Mm-hmm. Now that we're considering assessing all these statements about what's going on with central banking or the broader economy, how do you then piece together or understand the broader response to that?
What I mean here is that, I'll start with think of, investors as a colony of bees.
Yes.
The way I think to think about investors is not, individual decision making, but there are these patterns of crowd behavior. And that's the rules that I'm trying to talk about, the structure that I'm describing here, the way that public statements by, again, what we call in game theory missionaries, how we as the human animal, particularly in a crowd setting, how we're hardwired to respond to those missionary statements and messages. So we can actually measure it, and we can really think in those sort of terms. And that is back to how I want to try to make a difference, both in investing and as citizens, because the same sort of, I'll say, hardwired responses to these missionary messages, yeah, we see them in investing, but God knows we see them in politics too, right? So it's any sort of social system, you have these patterns of social interaction. And what I'm talking about doing is not fighting the man, right, or not fighting the Fed, or, we can't divorce ourselves from this, but it makes such a difference in our ability to step back from this and see what's going on. Once you start looking for narratives and missionaries and the way that people are trying to influence the crowd, you'll see it everywhere. You'll see it everywhere. And that really helps you create some distance between yourself and the people and the institutions that are trying to nudge you into this or nudge you into that. And that sort of distance, I think, is what makes for a good investor, and what makes for a good voter. I'd close with another, to sum that up is another poker saying, right? Which is that, it's the old saying that if you've been playing poker for 30 minutes and you don't know who the sucker is at the table, it's you, right?
Sure.
Right? What I think is so important about thinking in terms of narratives and the games that people are playing with your behavior is that it just keeps you from being the sucker at the table. Right, and there's real value in this, and that's what I'm trying to accomplish with Epsilon Theory and what we write. Just don't be the sucker at the table.
Do you see Epsilon Theory as out on a limb, or do you see yourselves as part of a particular school of thought that we should pay attention to?
So look, it's definitely not part of any specific political philosophy or economic philosophy. It really goes back to what I'm talking about in terms of this distance and not being the sucker at the table really goes back to I'll call it old school liberalism with a small L.
Sure.
The liberalism of liberty, of personal independence and free will.
I'm from New Zealand, so we still use the word liberal in the classical sense.
in the right way,
yeah,
exactly.
I don't know how Americans got on this. They flipped the meaning somewhere along the way.
They flipped it. I know, right? So
you basically interpret this as really some sort of return to a more classical understanding or acknowledgement of human behavior.
Yes, and trying to get people to recognize that there are these patterns and structure to how we are being influenced. And again, not to try to get people to fight the Fed or to fight it, because it can be very rational as an investor to go along with it. But I'm saying you don't have to believe it in your heart of hearts. What I'm saying is that you're smart enough to make up your own damn mind about things.
Right. So, yeah, we could keep on going. We've already gone over time. I appreciate that. The website is epsilontheory.com. Always go to goldnewsletter.com/podcast for the show notes. I'll put up the links to the articles mentioned today. Are there any other places you would recommend people go to that maybe guided you in your own thinking?
Well, we've got some reading lists up on our website. We're all standing on the shoulders of others, but if you start with Epsilon Theory, and I think it can help you out.
Okay, Ben Hunt, thank you for your time, and we look forward to having you maybe next year at the New Orleans Investment Conference.
My pleasure. Thanks again.
Cheers. Bye-bye.